Welcome, everyone. This is our top 11 year-end tax and financial planning ideas webinar. Very much hope it's going to be timely, essentially for everyone who joined. And I'll tell you, in the past, we try to do these events in December, and then we had some complaints when people said, well, we don't have enough time to implement your recommendations. So hopefully, 45 days will be enough for everyone, essentially. So again, for those of you who already know me, great, thanks for joining. For those of you who haven't met me yet, my name is Alex Seleznev. I'm the founder and president of Capital Squared Financial, and we're really all about transitions. And of course, your perhaps eventual transition into retirement is one of the most important transitions you'll ever make, and you don't want to do that for the second time in your life unless it's for personal reasons. Now we specialize in tax planning, and that's again what makes us unique. We meet with our clients at least semi-annually, and we usually talk about different strategies to minimize their taxes in the current year, of course, in the future years. And in terms of our investment approach, it's also fully custom. The most important idea is to make sure that each client has an investment strategy that matches his or her overall retirement or financial plan. We're a fee-only, full independent firm. We always serve as a fiduciary when we work with our clients. And I guess last but not least, also very responsive. So we usually respond to our clients within 24 hours. At least we acknowledge their requests, and a lot of people appreciate that. If you want to learn more, of course, visit our website or feel free to reach out to me directly. I'll be happy to address any related questions. So in terms of the disclaimer, again, for those of you who ever participated in investment webinars like this, or financial planning webinars, so of course nothing here should be considered investment advice. The information provided here is for educational and informational purposes only. We strongly recommend that if you decide to implement anything that we're about to discuss today, do your own due diligence or consult with a professional to make sure that that's appropriate for your unique situation. So in terms of the summary of what we'll cover today, again, top 11 year-end tax and financial planning ideas. We'll start with different retirement contributions and related strategies for both employer-sponsored and self-employed retirement options. We'll touch on college savings and other options that are available if that is something you're trying to accomplish. HSAs versus FSAs. There's still some confusion in terms of the benefits of each. We'll certainly touch on portfolio rebalancing and tax loss harvesting, which is perhaps it's usually done as part of the same process, but in some sense these are two separate strategies. Tax withholdings, exactly why. Under what circumstances should you review your tax situation and how to adjust your withholdings if needed. Manage and itemize deductions, less of an issue at this point versus what it used to be in the past, but still important. Tax efficient gifting, that's something that a lot of people are thinking about at this point. So certainly have some ideas there. And then of course, your required minimum distributions, and we'll touch on separate issues related to that. And then finally, we'll finish with some thoughts on how to essentially on the best way to start 2024. So let's get started. So in terms of maximizing your retirement contributions, and again, we'll start with the basics here. Very much understand that perhaps many, if not most people already understand this, but just to make sure we cover everything. So of course, there's significant benefits of making pre-tax retirement contributions. Specifically when you deal with traditional IRA or traditional 401k accounts, essentially by contributing on average, your immediate savings are right around 30% of the contributed amount. So to say this differently, let's say you made a contribution of $1,000. In terms of what it would feel like to you, it would really feel like you contributed something like $700 because of the tax savings on your contribution, and that's important. I like to point that out. There's the tax deferred growth, so you don't pay any taxes up until, let's say, you're age 73, which is the required minimum distributions age, or if you decide to draw at some point in the future, you'll be paying some taxes. Now, in terms of post-tax contributions, usually people refer to them as Roth contributions. Well, there are no immediate tax benefits, but the funds inside of the account essentially grow tax-free. An additional benefit here, once you reach your 73rd birthday, you would not be required to take any required minimum distributions. So again, very, very beneficial to make contributions like that. So how do you decide? This is one of the top questions I get when we talk about, retirement planning, retirement contributions. Again, usually this decision made as part of your overall strategy. There are multiple factors that you need to consider. But if we're focusing on taxes, focusing on this from the tax perspective, if you find yourself in the lower tax bracket, so 24% or lower, consider making post-tax or Roth contributions. And the reason that's the case, well, you would not be saving that much in taxes, and it would take you a relatively short period of time, especially if you're investing more aggressively or more growth-oriented portfolio, to recoup those tax savings. Now, if you are in a higher tax bracket, so 32, 35, 37, I would frequently recommend that you focus on pre-tax contributions, because essentially you would be leaving, 40, 45 cents in the dollar, especially if you consider state income taxes too, on the table by contributing into the Roth accounts. But again, there's some pluses and minuses of each approach, regardless of how you want to look at it. So in terms of traditional versus Roth IRA, so how do you decide in this case? Well, if you're single, and for those who are married, the threshold is on the bottom of the slide, and your income is below $153,000, well, you qualify for a direct Roth IRA contribution. Now, if you qualify and if you have the cash flow to make the contribution, pretty much always recommend that you contribute, right? Because it's limited. It's limited to $6,500 per year, or $7,500 for those over the age of 50, and you don't want to miss any years of contributions. Now, if your income is above $153,000, well, one of the options you have is to do what they call a backdoor Roth IRA. Now, there's a process. It's not necessarily that complex, but there's a 3-step process for you to do that, but you can still do it. And it's interesting, this loophole, it's been around for decades, I guess at this point. They've been talking about this for a while, but it's still there, so it's still possible to do it. And then finally, if you're, again, single and your income is below $73,000, well, you actually qualify for a deductible traditional IRA contribution. In this case, though, and you perhaps already noticed the question mark, if you're in that income level, I would frequently recommend that you still go with the Roth option, for the reasons I mentioned earlier, because you're not necessarily saving yourself that much in taxes. And perhaps over time, as your income increases, you would no longer qualify for direct Roth IRA contributions. So again, that's one of those situations where perhaps it would not make sense for you to save on taxes in the year of contribution, and instead go with the Roth option. In terms of the limits, you can see them on this slide. For 2023, it's $6,500 for your traditional Roth IRA. It's $7,500 for those over the age of 50. In terms of the increases for 2024, they actually made it simple this year. So for each type of account, it's $500. So for 401k accounts, for 2023, it's $22,500. For next year, for 2024, they increased it by $500 essentially. And again, in terms of the catch-up contributions, same thing. They went up by $500. Now, what happens if you're self-employed? Usually when I work with self-employed people, we certainly go over this in more detail because you have more options. And just one thing to make clear, essentially everyone qualifies, depending on your income, for traditional or Roth IRA contributions. So these plans would be in addition to that. So SEP IRA or self-employed plan IRA, how much can you contribute? Well, it's the lesser of 25% of your net income, or $66,000 in 2023. So there's a simple calculation for you. Let's say you have $50,000 of income, you have $10,000 of expenses, so your net income is at 40K. Essentially, 25% of that would be $10,000. So that's how much you'll be able to contribute. In terms of the due dates, by the way, this does not need to happen in the same calendar year, even though perhaps that would be your preference. You actually have until the tax deadline, which is of course April 15th, to make your contribution. If you go an extension, you have even more time, which is, by the way, very beneficial for self-employed people with so-called lumpy income. So it's a great benefit. Now, solo 401k accounts, in some sense, they're similar, but usually I would say they're more advantageous, especially if you have more income and that income is more consistent. So the contribution limit is $66,000, but the catch-up contributions are also available, so $7,500 for those over the age of 50. Now, with solo 401k, what's important to point out, essentially you can contribute as your own employee and your own employer, because you're in some sense wearing two hats. So as an employee, you can contribute $22,500 per year. It needs to happen in the same calendar year. And then as an employer, again, of your own firm, you can essentially contribute the remaining funds. Now, if this is, confusing for any reason, I'll just say this. Usually you can contribute more into the solo 401k account. So that's one of the reasons I would frequently recommend them versus SEP IRA accounts, especially for people who are, thinking about doing this for multiple years. There's some administration involved. It's really not a big deal. You'll just need to file a form 5500 once the value of the account reaches $250,000, but it's really not a big deal in most cases. So how to decide which option works best for you? Well, here's a cheat sheet for you. For a SEP IRA account, if your income is lower and or inconsistent, well, chances are this is the best choice for you. Why, complicate your life, go with the SEP, and that's the end of it. Now, if your income is higher and you expect it to be more consistent in the long run, you really want to maximize your contributions, I would really start with a solo 401k. And this is, again, in terms of me, meeting with my clients and trying to determine what plan they should have in place, I would literally ask these questions to determine that. Now, here's what's interesting, and this is one of those situations where it can be really situational, but it can benefit you quite a bit if you really qualify for this. So-called cash balance plans. They usually work well for those who are self-employed or small business owners, essentially, so have a couple of employees. Those who have stable business income, that's very important. And one of the reasons why you'd want to create a plan like this, well, they come with very significant contribution limits that are actually age-based. So we're talking, up to $400,000 or so. It can be a bit more, a bit less, actually, on a pre-tax basis. So it can be incredibly powerful. Just to demonstrate how it works. So actually I have a couple of clients, but one situation, I think it's a great explanation of that. So post-divorce, she essentially ended up with, well, nothing, but at the same time, she was really good at her job. She, established her own medical practice, and over a relatively short period of time, her income really began to skyrocket. I mean, she was very successful. So one of the questions we had is, of course, how to save as much as possible in terms of her taxes, right? Because she was essentially in the highest tax bracket, and she got there very quickly. And then the second question, well, how to catch up on essentially decades of lost contributions in terms of her retirement planning. So the cash balance plan worked out really well for her. She's been doing it for a little over 7 years now, and I'll tell you, she is on track for a comfortable retirement. Again, a very powerful option if this works for you. All right, so college savings. So this is again one of the options that is available for you throughout the year. Just notice that many people focus on this closer to the end of the year. So this is not meant to be a full overview of the benefits, but in terms of the 529 college savings plans, they are essentially the most versatile option for college savings. It applies to both parents and grandparents, by the way, who want to support their children. Now, one of the newer features that some people take advantage of, the funds inside of the 529 plan can now be used for K through 12 private school tuition, up to $10,000 per beneficiary. So that's important too. Well, what are the benefits? Well, your contributions into the plan are tax deductible only at the state level. So that's important. Sometimes people are confused, but only at the state level, which is why it's important to contribute into your state-specific plan if you want to get that deduction. The growth in the account is essentially tax deferred, or feel free to call it tax-free, as long as you use the funds for qualified expenses. So room and board, tuition, there's a long list of different qualified expenses. Essentially, every plan I know of has multiple investment options, so you can always tailor it. You can invest more aggressively or more conservatively, depending again on your specific needs. Now, one thing I really like to say when I have this conversation, well, what is the best time to contribute? Well, the best time to contribute is really before your child is even born or grandchild. And that's actually what I did for my son Nikolai. Before he was even born, I created a plan for myself, and then I simply changed the beneficiary when we got his social security number. So I got an extra year of contributions. So in terms of the limits, this is for those who are in the DMV area. So in Maryland, it's $2,500 per beneficiary per year. And just to confirm, we're talking about deductible limits in terms of how much you can contribute. It can be up to $500,000 actually, but in terms of the deduction, it's $2,500 per beneficiary per year in Maryland. There's a carry forward provision of 10 years. So just to give you an example, if you contributed $10,000, you would deduct $2,500 in year one, and then the remaining $7,500 over the next 3 years. You just need to keep track of that. In Virginia, it's $4,000 per beneficiary per year. The carry forward is unlimited, which is great, by the way, for those who want to pre-fund their children's education. Let's say they received an inheritance and they really want to use the money for that purpose. In District of Columbia in DC, it's perhaps the least advantageous. It's only $4,000 per taxpayer, or $8,000 if you're filing a joint tax return. And that's again one of the confusing points. If you have 5 children and you made contributions for into each of the accounts, you'll still only be able to deduct essentially $8,000 if you file in jointly, or $4,000 if it's single tax return, and the carry forward is 5 years. Can you do more than that? Well, yes. If you have the money, again, you can create so-called Uniform Transfers to Minors Act accounts. Most people simply refer to them as UTMA accounts, and essentially think of them as tax-efficient accounts for minors, essentially for people under the age of 18 or 21, depending on the age of majority in your state. Now, very frequently they're used to essentially supplement your 529 college savings, because you can actually use the money for things that the 529 plans would not qualify for. So a perfect example of that would be travel expenses. So very frequently people use it for that. In terms of planning, if you decide to create an account like that for your child, well, you really need to keep it as tax efficient as possible. And the reason I say that, because essentially the first $2,500 of income in the account would be tax-free, because most children, I would say, they pay no taxes. And then any additional income would be taxed at your tax rate. So in terms of the contributions here, without giving you any specific amount, probably talking several $1,000s. You know, the largest UTMA account I've ever seen, it was at like 70,000 or so. And again, it accumulated in value over time. All right, so health savings and health savings, HSA and FSA accounts. And there's still some confusion, you know, between the two types of accounts. They're somewhat different. So with HSAs, it's very important. They're part of a high deductible health insurance plan. There's really no other way for you to have access to an account like that unless you have a plan like that through work. If you're self-employed, you can create it for yourself. The other important piece is HSAs are portable. So if you ever leave your employer and you made contributions into your HSA, it's still there and you can essentially continue to use the money. You would not be able to fund it though. FSAs are different. So FSAs, they work with your employer's healthcare plan. And the idea here is to essentially cover some additional medical expenses for you in the year of contribution. So as you'll see on the next slide here, there's usually a grace period. A couple of months is how much they give you to essentially spend the rest of the money, and you can carry over up to $610 to the next year. But again, the goal is really for you to spend the money. So in terms of planning for your FSA, the idea is to figure out how much you need and then spend it within the plan year. HSAs are very powerful. I like to refer to them as medical IRA accounts because they essentially come with, triple tax benefits. You get an upfront tax deduction for your contribution. The funds inside of the HSA account grow tax deferred or perhaps even tax free as long as you use the money for qualified expenses. And of course, as people age, chances are that we'll have those types of expenses. So usually, again, in terms of planning for next year, in terms of the current year, maximize your 401k, try to maximize your IRA accounts, and if you have access to an HSA account, try to maximize it too, because it's again very beneficial to you. All right, so portfolio rebalancing, kind of changing gears here. So I'm sure essentially everyone heard about this strategy, but why exactly should you periodically rebalance your portfolio? And just so you know, I usually recommend that my clients do this at least annually, and as you get closer to retirement, I usually suggest at least semi-annual rebalancing. Well, perhaps one of the primary reasons, again, everyone heard about this golden rule of investing. You buy low and you sell high. Well, that's great, but exactly how can you do that? Well, periodic rebalancing is essentially a systematic way of doing exactly that. So let's say you have an investment policy or investment strategy. I don't want to get too technical here. You want to maintain 70% in stocks and 30% in bonds. Let's say you decided that you're going to review your portfolio semi-annually every June and every December. You look at it in December, and let's say stocks significantly outperform bonds. So what are you going to do? You're going to sell some of your stocks and you're going to buy into bonds. And again, this is a very simplistic example, but by doing this, you avoid market timing, and I mean in both directions. Sometimes when the markets are going up, people just want to buy because that fear of missing out. And the opposite is also true. If/when the markets begin to get volatile, sometimes people panic and start selling. So it really prevents you, or at least helps you to prevent your portfolio from those negative consequences. So where to begin? And again, we can spend a lot of time on that, but probably not in our webinar today, but I'll just still give you some pointers here. So what you're looking at here on this slide, this is a so-called Morningstar Market Barometer. This is as of October 31st. It really hasn't changed all that much over the past 15 days or so. So hopefully one thing you can easily see is that large cap growth stocks right here. They really outperformed essentially everything else this year. Again, as part of this webinar, I cannot give you any specific names, but these are some of the largest, again, stocks in the US. Now, growth stocks, just in general, they tend to be much more volatile than other categories. And one of those things, nothing really grows over the moon, and it's just a matter of time, when they begin to go down. So, and this is not any kind of call to action in terms of selling all of them, but at the very least consider reviewing that allocation of your portfolio. If you're looking for a more balanced mix as part of your strategy, well, chances are you would really need to tweak that portion again of your portfolio. And also say that at this point, something I've been focusing on over the past couple of months, actually, bonds have very good yields. So for those who are, again, getting closer to their retirement years, it can be quite beneficial to focus on bonds at this point. So tax loss harvesting. So again, perhaps many of you, heard about this strategy. It's one of the perhaps most beneficial tax strategies for those with taxable or brokerage accounts. I would say, unfortunately, if most of your investments are in IRA, 401k or any other tax deferred accounts, it's not necessarily going to work for you, but still something for you to know. So the goal here is to reduce or hopefully eliminate your capital gains and related taxes. And if done properly, in many cases, you can do this in the current year and also in future years. And there's going to be an example of how I'll demonstrate how this can be done. Now, when you harvest losses, they'll be reported on your Schedule D of your tax return. And again, the carry forward is unlimited. I get this question all the time. Well, I harvested $50,000 in losses. I don't really have any gains this year. Did I waste my time? Well, absolutely not. Chances are you will be able to use those losses in the future years. Now, in any year when you don't have any other losses in terms of capital gain, any other capital gains, you'll be able to use up to $3,000 to offset your other income, which can also be beneficial. So the bottom line here is really to structure it in a way when you harvest losses without any significant impact on your asset allocation. So the idea is to sell holdings that have losses and replace them with similar but not identical funds. Again, where to begin? This is the market barometer. You've seen it a moment ago. Again, growth stocks appreciated the most this year. If you study this in more detail, well, many mid and small cap stocks or funds, which are frequently included in balanced portfolios, actually haven't appreciated much in value. Many value stocks, so those more dividend oriented, more mature, they're actually in the negative this year. So that's something where you can focus on. International emerging market stocks, they're actually some of the better performers earlier this year. They're either flat or in the negative, again, many of them. And longer term bonds. And this is more of a technical point, but if your portfolio is mostly in bonds and you have different categories, that's something for you to look at. So here's an example. One of my clients, her name is not necessarily Catherine, and this is not her photo, but just to give you an example. So I'm sure everyone remembers 2020. In March of 2020, during this whole COVID pandemic, the markets were down by 31% in 17 calendar days. So it was a very dramatic decline in value. So as a result of that, there were plenty of opportunities to harvest losses. So Catherine here was able to harvest $50,000 in losses. Now, there were no other gains in 2020, so she used $3,000 to offset her other income, and then $47,000 again remained on her Schedule D, essentially. As I mentioned earlier, there's this unlimited carry forward. Now, 2021 turned out to be a much better year. So there were some capital gains. In her case, it was $30,000. So she used her prior year losses to offset 100% of her capital gains in 2021. And she still had some remaining. So what's the outcome here? Well, she paid no capital gain taxes for 2 years. And when I was preparing for this webinars, I was thinking, you know, perhaps I should come up with more of a, you know, dramatic example. I certainly have some, but I didn't want to, you know, do it that way. But there's certainly situations, you know, when you do it proactively, when you don't pay any taxes for many years. Again, if you really stay on top of this.